What's up, guys? It's Michael Key, and I want to start this off real quick with two things. The first one, I apologize. It's been a little bit since I've made a video. I had a busy schedule with work this week, and I will be back to uploading every day to every other day from here on out. The next one, I have a book recommendation. Think Like a Freak. It's a 3-part series. The authors also wrote Freakonomics and Super Freakonomics. They're extremely good books. Both of them, I believe, are economists, Stephen D. Levitt and Stephen J. Dubner. This is what got me into economics and investing. They're very good books, very interesting, and definitely worth the read. And I'm actually going to start this off with a section out of the first chapter. And it definitely relates to investing. Let me find it here. So they're talking about what the 3 hardest words in the English language are, and they concluded after multiple studies that it's I don't know. Saying I don't know is the most difficult 3 words to say in the English language, which doesn't surprise me. But there's one study that stuck out in the first chapter I wanted to bring up because it just goes along with a lot of the stuff I've said on my channel. So it says a similar study by a firm called CXO Advisory Group covered more than 6,000 predictions by stock market experts over several years. It found an overall accuracy rate of 47.4%. Again, the dart throwing chimp likely would have done just as well, and when you consider investment fees at a fraction of the cost. So there's a lot more to that chapter. That's a very good chapter and a very good book. Experts, stock market experts, these technical analyst people and all these other people, 47.4% accuracy, which means they're worse than just flipping a coin. So for all you day traders and all you people that watch these economists on the news talking about how we're going to have a depression or you know, all you Jim Cramer people looking at what kind of stocks are going to hit next and AMC and GME and all that stuff. Some of the smartest people in the world, 47.4%, which means that you're better off flipping a coin. So I just wanted to point that out. I thought that was pretty interesting. Next, what I'm going to talk about today is a few variables that will eliminate some of the risk when you're trading options, but it'll also keep you from losing a lot of stupid money. And when I say stupid money, I mean things that you can actually maybe control that you necessarily wouldn't pay attention to normally. Some of them you would always pay attention to, but there's one I don't think a lot of people pay attention to. So I came up with a list on the most important factors to consider when you're going to enter into an options trade. The first one I've talked about in a previous video, and that is implied volatility. Absolutely, I will hold true to that's the number one variable to consider when trading options. And if you haven't seen that video, go look at it, and I'll attach the link in the description, and it talks all about that. Looking at implied volatility is going to dictate what side of the trade you're going to take. Are you going to buy or are you going to sell? After implied volatility, the next factor I look at is liquidity. Liquidity is very important. That's volume. Liquidity means, can I get out of the trade? Can I put it back into cash? Can I sell fast? If an underlying has high volume, it's considered liquid because there's a lot of buyers and sellers. And usually that can transfer over to the options market for that particular underlying, but not always. So you got to pay attention. Some dates have more liquidity for options than others. Generally, the regular option expiration dates, which is the 3rd Friday of the month, those expiration dates have more liquidity than weeklies do. So you want to pay attention to all this. Here's why. So you have a bid and an ask price, and this goes for if you're trading stocks or options. The bid price is the price that someone's going to buy from you. This is the lower number. The ask price is the price that you're going to pay. So, with an example with options, let's say your quote you see is $5 for a call option is the bid price, and then $5.50 is the ask price. There's a 50-cent difference between these two. Now remember, you're going to pay this price and you're going to be able to sell for this price. This is why I always see people asking, how come the stock or the option always goes down immediately after I buy it? More than likely it's because they don't understand that they're buying positions that have a wide spread. and you're paying this higher price. So immediately the only price you're going to be able to sell it for is that bid price. Now with the current market environment and the way commissions are and everything, they don't charge commissions anymore. The broker makes a difference on the spread. But a lot of times you can get your orders executed at the midpoints. So if you're looking to buy an option, and this is the quote, your order that you'll probably have executed is going to be somewhere around 530, I'd say, is what you would pay. That's why you can have your trading platform set up to where it's showing you your gains and losses for that day would be based off the midpoint prices. So you need to consider this when going to enter a trade, because with options, this is magnified. This isn't just a 50-cent spread. On an option, this is a $50 spread, because remember that this 0.5 is actually equals $50 because you multiply it by 100. Because you'd be paying $550 for the whole thing. So if you had bought call option at $5 originally, and the stock went up, and you're like, oh, I can get, I want to sell for $550. No, because you'll probably get executed around this. And you don't want to do a market order. You want to do limit orders. This is why you always want to do limit orders, whether it's doing stocks or options. I think I read a study that said all successful traders, the one thing they had in common is they don't do market orders, because when you're looking at a spread that wide, you're going to get crushed. You're losing money. You're paying a stupid tax for it. So just remember, you want options that have a tighter spread. So like if this was on Amazon, let's say, that's not bad, because the underlying costs so much money. And these would be far more expensive. But if it's something like Apple, a 50-cent spread is not liquid for Apple. You can find them with a couple cents apart. And when you're looking at cents, that's dollars in options. So it's even more money. So it needs to be liquid. The next most important one is time, how much time you have till expiration. But when you take time into consideration, you need to know, is it in the money or at the money or out of the money on the option that you're going to be trading. The reason you need to know that is because you need to know the intrinsic and extrinsic value on the option. Did another video where I explained what intrinsic and extrinsic value is, but I'll recap it. Intrinsic value, I'm just going to write INT, equals in the money. How far the option is in the money. Extrinsic value, I'll just write EXT, equals time value and an option is made up of those two combined. So let's say we have XYZ stock trading at $100 a share. And we buy one call option with a 90 strike price. We buy it in the money. So call equals a 90 strike. And we paid $1,500. So it'd be quoted like this. It'd be quoted as $15. Based off of this, we know that the only real value that this option has is how far it's in the money. So you would go the difference between those two. 100 minus 90 is 10 times 100 equals $1,000. So 1,000 of our $1,500 is the only real value that that option has. So you would split that up. So we have $1,000 that we'll retain if the stock doesn't move, but we have $500 that will go away at expiration if the stock doesn't continue to climb. We need to know how much time we have, because that's how much time decay is going to affect us by expiration. So if you're trading an underlying that doesn't move, it's just going to go away. An option's only value is how far in the money it is. Intrinsic value is the only true value an option has. So you need to know that if you're buying out of the money call options, the only value you're buying is time value, and it's not even real value. You're paying for the potential that it'll, and you need to think of it like that. You're only paying for the possibility that the stock's going to go up to the price that you chose. If you buy them in the money, you're buying actual intrinsic value. You're basically buying the spread on the current price and the strike price. And then if it has any extrinsic value on top of that, then you're paying a little extra. This is why I like buying deep in the money call options instead of out of the money call options. Yeah, I pay more, but I'm not taking the time risk, or at least not as much of the time risk. So those are things you really got to consider when entering into an options trade. And this stuff works not just with calls, but with puts also. But puts can be a little bit different because if you're using puts like to hedge a position, you already own the underlying stock generally. So you can take a little more different approach, but it's the same concept. So you just need to think about that when you're evaluating how you want to trade options. And those should be the main things. So implied volatility, volume, time to expiration, and intrinsic and extrinsic value on that option. What are you going to lose from time decay? And then how much every day are you going to lose from time decay? Because every day that option becomes more and more and more worthless. So if you like the video, hit like. If you have any questions, you can email me, and I'll put the links to the other videos below. So hit like and don't forget to subscribe. Thank you.